Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Just kind of summarizing that non-farm payroll data. The good news was, for the month of February, came in better than expected. 275,000 jobs added. Consensus was 200,000, so a good headline print there. Kind of the little bit of the downside here is a big negative revision for the prior month. The prior month was revised down from a gain of 353,000 to 229. Claudia Somm from the Somm Group said, don't worry about it. It's just noise.
Taking it in stride.
Take everything on like a 3-month basis, rolling basis, and basically the payroll market's pretty strong. Joanie Bily joins us, Chief Workforce Analyst at Employbridge, reportedly on Zoom from Pompano Beach, Florida. What are we doing
You're
wrong?
jealous, right?
Yeah, why not? But I'm going out to the
understand.
mountains Sunday, so I'm all right. Joanie, what did you make of this jobs report number today? A lot of moving parts, as we've been saying.
Yeah, you really have to break it down because there is a lot of data in this report, and there's some good news and there's some bad news. So to your point, you were talking about, the revisions that were made to the prior months. We did see some pretty big revisions downward to January, and then also some revisions in December. So, the previous month's reports weren't really as strong as we thought they were. But however, if you look at the overall job growth, the U.S. is adding jobs to the economy, mostly in the healthcare sector. We did see growth in the retail sector. Construction added over 20,000 jobs. So, there is some good news. And we continue to see wages also moving up in the report as well.
So, but Joanie, do you
Yes.
care that the wages were moving up less?
Yeah, we're definitely seeing a slowdown. I think with, wage growth has been so strong over the past few years. So I expect them to flatten. I do think, wages will kind of soften. But I was surprised actually to see that we're still having some decent wage growth.
So
the one thing,
go ahead,
I'm
Joanie.
sorry. Well, the one thing I was going to say that concerned me the most about this jobs report was actually the household survey. Mm-hmm. And that's where you saw unemployment, tick up to 3.9%. And when you look at the data and kind of break that down, we see that the population is growing, the size of the labor force is growing, but we actually have over 330,000 more people on unemployment. And that concerns me. So, we have these two surveys. And so when you look at, the establishment survey, the headline number of, 275,000 jobs being created looks great. But that household survey is really concerning that we're seeing more people on unemployment.
So, Joanie, I think when you listen to earnings conference calls from companies in just about every industry, they say it's still really hard to attract and retain good talent and labor. Are you still seeing that? Is it as acute today as it was maybe a year or two ago?
Yeah, it's definitely softened a bit. The job market, was much stronger last year and the prior year. Even coming out of the pandemic, we just had robust growth. It was a very competitive market. People were quitting their jobs, going somewhere else. The grass was greener, making more money. Now we're starting to see, the quits rate is coming down. It is still, though, a very tight job market. To your point, we have 8.9 million job openings, about 6.4 million unemployed workers. So more jobs than there are people. But it depends on the sector, that you're in. We've seen a slowdown in some of the professional and business service sector. Healthcare, though, continues to remain strong. Leisure and hospitality, it is very hard to find people in that industry. So we've seen wages really start to increase, and employers are focused on that, employee retention strategies to keep their workforce engaged and keep them with them.
So to that point, the market is pricing in now 100 basis points of cuts this year. It really starts to kick off in June. Is this an economy that needs that? Like, if we do get those cuts, is there now pent-up demand with companies that would actually make the job market tighter?
Well, I do think if we get those cuts, even if it's in the second, half of the year, that will help many companies feel better about investing and start hiring again. Because what we see at Employbridge is employers are talking about hiring. They say they have the demand, but they do seem a bit cautious. They're not adding, to their payrolls as quickly as they have before. And I think they have to be careful with their cash position, and certainly, their debt. And the interest rates being high, of course, that's impacting companies with making those investments. So if we start to see those rates, begin to ease, I would certainly feel better about companies starting to add to their permanent payrolls again.
Joanie, last night was the State of the Union address, and one of the key issues was immigration issues at the border. How is immigration, whether it's legal or illegal, how's it been impacting, or have you seen it anywhere in the labor market? What are your clients saying? Because I was speaking to a buddy of mine who owns a restaurant just yesterday, and he was saying for the first time in 3 years, he actually has everybody he needs for all his shifts. And these are busboys and waiting staff and dishwashers and things like that. Has it shown up in your work?
Yeah, so I think it's still too soon to tell, to be honest with you. It definitely will have an impact when you look at the numbers of people that are coming into the country. Obviously that's adding, to the population, and many of them are unskilled workers, so they will really, if obviously getting their green cards or being able to work in the United States, they will impact the lower level jobs, looking for talent more in those unskilled positions. And we see that we haven't really seen a big impact in the workforce yet, but it certainly would impact the workforce in the future.
What do you look for next then? So if there's some good and there's some bad, it's like a Rorschach test, right? When it comes to the jobs data, what's going to be the next data point that you're really paying attention to in the jobs numbers?
Well, I think there's a couple things that we need to continue to watch. One thing is labor participation. If you look at the overall workforce, we're at about 62.5% labor participation. And then if you break that down, men over 20 years old were up at 70%, which is a pretty good number. Women for over 20 years old we're at 59%. So when I look at the overall job market, I'm also looking not only where is the job growth and who's adding, what's happening with wages, but are we getting people back to work in the United States? And are we seeing that labor participation start to tick up? And that's a very important indicator that I certainly watch. It's still at a very, very low rate. And we have some work to do, I think, in encouraging people that it is a good job market. There are opportunities out there. There's training opportunities out there, and certainly need to get that number up. I'll also be watching for revisions next month. Are the numbers getting continually revised downward? The temporary help sector is interesting to follow. Usually, if we're losing jobs in the temporary help services sector, that's not a good sign for the economy, because companies will lay off temporary workers first. And unfortunately, that has been declining for many months, which could show us that we're not out of this yet. There definitely is some softening.
Joanie, we appreciate your time. Thank you so much. Joanie Bily, she is Employbridge Chief Workforce Analyst, joining us there. We very much appreciate your time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Friday to everyone. We made it to the end of the week. You're listening to Bloomberg Intelligence on Bloomberg Radio. You can also check us out on YouTube. We are live in the Interactive Broker Studio right here at headquarters in New York. I'm Alix Steele, Paul Sweeney as well. So we have thousands of analysts, hundreds? Let's go with hundreds. Hundreds of analysts that cover 2,000 companies and 130 industries around the world. They are truly the best of the best. And One of the headliners here is Gina Martin Adams. She is the chief equity strategist at Bloomberg Intelligence, and she joins us now from the Golden State. Gina, I'm looking at the market, and I've been skeptical of the rally for a long time. But then I get things like the Russell 2000 up the most and hitting its highest level since March of 2022. Then I get things like you have the equal weighted index sitting at a record high. You have industrials doing really well, and it's not just Uber. Is it time for me to stop being skeptical?
Yeah, I dare say, Alix, we should have convinced you a little while ago to stop being skeptical. But frankly, I do think that what is happening in the market, you're not alone. There are a lot of people that are very skeptical in the market, and that is what makes the wall of worry that stocks tend to climb, right? And I do think, though, that when you look at the bulk of the evidence, you see fundamentals starting to turn a corner for the vast majority of the S&P 500, and prices are reflecting that corner that fundamentals are turning. Over the course of 2023, of course, the big argument against stocks was that this market was really just driven by the biggest names, but that argument has been diminished considerably over the last 3 months. We're starting to see breakouts across the board. As a matter of fact, more than half of industrials companies are making new all-time highs over the last 3 months. So you are starting to see much broader gains emerge, small caps starting to show some signs of life as well, breaking across key resistance levels just this week. So we're starting to see more participation, more capitalization participation, more sectors, more stocks really getting on board this bull market.
So I guess just on the back, Gina, on the jobs number today, it seems like the bond market is pricing in pretty confidently a rate cut in June. Give us just kind of what your Fed outlook is for kind of the remainder of this year, and how important that is to kind of just the overall fundamental, the movement of the markets.
Yeah, so luckily, Paul, that's one thing I don't have to set as a Fed outlook, but I will say that what the equity market is pricing is generally we're starting to adopt the thesis that earnings are improving.
Yep.
I do think that what's really driving the equity market more than anything is not what's happening in rates. As a matter of fact, we see some very clear evidence that equities are detaching from the rates landscape, and we're not necessarily as closely correlated on a daily basis, monthly basis with what's happening with rates and the bond market speculation about the Fed. And instead, we're looking at much stronger than expected earnings and cash flow growth that has emerged for the S&P 500, and the anticipation that maybe earnings actually will prove to be much stronger than the market was forecasting over the course of this year. I do think that that's the most important driver of stocks. That said, you can't completely ignore the Fed. If the Fed is going to, even just modestly reduce interest rates because inflation risks has diminished, that could be very supportive of equities as well, and certainly contribute to valuations. I think the most dangerous condition for stocks right now is one of two things happen. First and foremost, the biggest sort of not predicted component of the market outlook is this idea that maybe inflation is stickier than anticipated. If inflation reaccelerates, that is obviously very bad for stocks because it could compress profit margins. On the other end of the spectrum, if the Fed is easing policy because growth is breaking down, that's also not great for stocks. We need this middle zone of sort of stable policy, stable inflation, and modest improvement in earnings growth to really support the equity market right now.
That is a Goldilocks word there for Gina. Okay, but here's my question is that if we do get the cuts that say they start in June, and neither of those negative scenarios imply, like there's no sticky inflation and there's no disastrous economy, the risk of the cuts is that we actually fuel more investment into an economy that doesn't need it. And then that kind of sets us up for a rougher 2025.
I think that's a really good point, is how much can they cut before they ultimately, the ultimate result is another bout of inflation into 2025. And we won't know this until we get to mid-2024 when they do start cutting, if they do. But the Fed does have to thread a pretty fine needle. If we're at a point where growth is relatively stable and inflation is simply decelerating, I think the arguments for those cuts are relatively de minimis. So if we do get to that point and the Fed does start cutting, you could indeed see the market start to think about, well, what does this really mean for inflation prospects in 2025? Is it justified to see this sort of outlook from the Fed Will we see much more volatile inflation conditions emerge, and what will that mean for profit margins? That, of course, comes in the landscape of we do have the election coming later this year. We've got a lot of other potential moving parts to contend with in the economy, but it's certainly one factor to consider.
Gina, I'm glad you brought up the election, because we had the State of the Union last night, so it just feels like that's kicking off what's going to be a very long campaign here and a very long process. Historically speaking, how do markets perform in a presidential election year?
Yeah, I think, Paul, I tend to dismiss a lot of those sort of the statistical evidence about election years, because you get very different results if you talk about how seasonality and political cycles play out over the last 20 years versus the last 50 years versus the last 100 years. So you can kind of pick your narrative.
Yep.
I think the things that are most important, of course, to drive stocks really are what's happening with growth and inflation. That said, as we move closer to the election, I do think that there are two major macro issues to consider with respect to the 2025 outlook, and they will matter depending upon who ultimately becomes the U.S. president, and that is really tax and trade. Tax and trade are the two issues that could have very meaningful impacts on the outlook for earnings growth. Both of these presidents do tend to have quite bipolar policies with respect to especially taxation, but also trade policies and sort of international framework of relationships. So I think we want to pay pretty close attention to those two issues as we get closer to the election, because they could have meaningful outcomes for equities going into 2025.
So before we get there, I just want to, and before we let you go, enjoy the weekend, I want to get your take on what's happening with certain areas of tech. So if you have Tesla, if you have Apple, if you have maybe Alphabet starting to really break down,
Yep.
but yet you still have the NASDAQ 100 at a record high, how long do you think that divergence can last?
Yeah, I think this is super interesting, Alex, and something we've been actually exploring over the course of the last 2 weeks as well. Is what's happening in the market is quite interesting. Beneath that headline, what we see is actually tech stocks' relative performance failing to make new highs. So tech appears to be consolidating. Even communications, as you noted with Alphabet sort of breaking down, communication stocks have been in a bit of a downtrend. At the same time, the broader markets are moving higher, and that's because we're seeing greater participation outside tech really push those markets higher. Within the NASDAQ, for instance, you started to see breakouts in healthcare. Healthcare, of course, was this horrible laggard in 2023. If you get momentum gains in the rest of the market and tech just stalls or even starts to break down a little bit, you can see stocks work. And the last week and a half or so proves some evidence of that case. We do need to see, though, participation continue to emerge in the rest of the market if tech is indeed going into a stall state.
All right, Gina, thanks so much for joining us. As always, appreciate it. Gina Martin Adams, Chief Equity Strategist for Bloomberg Intelligence, joining us from Zoom from NJ.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get broader market. I want to pick up on where John Tucker sort of left off there, which is the Russell. It's at a highest level since 2022. And again, the signs of the broadening part of the rally and all of that significant as certain parts of tech really start to underperform. So joining us now is Grace Lee, Senior Portfolio Manager for Columbia Threadneedle. She is standing by for us. Is this the moment for value, and is it going to last?
That's a great question, and thanks for having me on today. I think we're getting closer to a tipping point for value. I think last year our value was certainly hit with a double whammy of rates rising, hurting a lot of the defensive sectors, and then you had the AI trade where value really doesn't play very obviously in the first round. But I think right now what you're seeing is people are looking for other opportunities and even other ways to play the AI trade. And we're seeing rate cuts on the horizon. And I think that's also going to be, it's going to drive a return to some of these underperforming sectors from last year.
Grace, how do you define value?
Ooh, I like this.
Well, we look at value in a number of ways. I think, we do look to the Russell 1000 value as sort of the broader index. But but it also involves just looking for undervalued opportunities. And so, I think one thing that has been overlooked is that a lot of companies are going through transformations, and as much as people think that equities are overvalued or something, but there's always pockets, and we look for those pockets. I think Citigroup is actually a really interesting example where the company is going through a significant transformation, simplifying the business, really driving better accountability, and that stock still trades at maybe 70% of book value, and we think that one's very interesting. So we look for those types of opportunities where even in a very strong market, you look under the covers and there's always something there that looks interesting.
What gives you confidence that this time will be different? I mean, I feel like value, well, specifically small caps, let's just go there, had their chance, their moment last year. It just didn't last for very long. What do you think?
Well, I think it does feel like it's always one step forward, two steps back for value. And I think, to a certain extent, you can certainly extend that to small caps. But I think over the long term, there is mean reversion, and it's always hard to pinpoint exactly what will drive that and when that will happen. But AI is not going to eat the world. It's certainly growing very fast, and we have very high optimism on what it can accomplish. But there are other sectors, and things have to sort of normalize a bit.
So are there sectors per se that you like here, or do you kind of go stock by stock? How do you guys screen for value?
So there are some sectors that are interesting. I think healthcare, which was mentioned earlier, there's a lot of interesting value names there. Pfizer, I would call out, is the stock dividend is actually higher than any of its A-rated bonds right now, which is an interesting setup. And they've been emphatic in terms of saying that they will support that dividend. So I think that one's interesting. So aside from healthcare, I think there are also very company-specific opportunities. And we've looked at the AI trade, and AI is not value, but there are certainly opportunities for AI participation amongst value names, and I think that's probably one of the most interesting things within our space right now. So I think old tech is actually seeing a bit of a renaissance driven by AI, where people used to think that servers and storage were kind of low growth, maybe dead for a while because everyone's moving to the cloud and they need less hardware. But as we're seeing now, that is not the case, and there's AI servers that's driving a lot of growth. Both. So I think we saw that specifically with Dell, which we're actually involved in, and that company. It was not initially an AI play for us. It was really that PCs are going to see a refresh cycle. Servers and storage will certainly pick up. And they might gain a little bit from AI. It looks like the market thinks are going to gain a lot more from that.
Yeah.
And then you've got old companies like IBM, which I think, again, has really transformed itself over the last couple of years and become more of a software and services company, which is not how you think of the traditional IBM.
Yeah, and that's exactly what we pointed out, and Paul in particular, after earnings for Dell. Like that stock just like shooting up. It's like, oh, right, Dell's still around. They do stuff. You also like some utilities. Why?
So what AI is going to do, it's going to drive a lot of power demand. And there are some, and they're probably not, they're in the utility category, but they're the independent power producers. And they're the ones that will benefit directly from higher power prices. There are some that own nuclear assets where clean energy or clean power is actually going to be very much in demand by the large hyperscale cloud providers as they want to balance their environmental goals with this massive demand for AI power. So So I think there's opportunities there, and I think companies that own power producing assets, and especially nuclear assets, are very well positioned.
All right, Grace, thanks a lot. We really appreciate it. Thank you so much for joining. Grace Lee, Senior Portfolio Manager for Columbia Threadneedle.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about the real economy for a moment.
Real world.
Yeah, let's talk about the real world here. So ARCADUS is a company based in Amsterdam, but the bulk of their revenue really now comes from the U.S. and Canada. And they do things like sustainable design, engineering, consultancy solutions for assets. They build stuff. And just to make Paul happy, they are also working on the Hudson Tunnel project.
Oh, thank you.
That's going to get about $12 billion in federal funding. It includes 2 4.5-mile-long tracks and tunneling. It's a big deal. So I always love checking on these companies because they're the people who are putting shovels in the ground, right? And that's what we really want to understand. And we're lucky now to join Virginie Duperat. She is CFO of Arcadis. She's in town joining us. It's so wonderful to have you here. Thank you for joining us.
Thank you, Alix, and thank you, Paul, and very happy to be with you this morning.
So in Amsterdam, over in Europe, I should say, we're at a 52-week high for the stock, earnings super good. You got a strong story. I just want to get your take on kind of how's it going? Like, what demand is like? Where in the world are you seeing the most demand, and for what stuff?
Thank you, Alix. I think that we are in a very buoyant moment. Frankly, it did not started yesterday. Already, I think, just after COVID, we started to see some changes. But definitely, there is quite an ask at the moment for more sustainable things and quite a change also. We see a lot of traction in the sustainability space, both in Europe and on the US continent. And that happens in very different areas, such as climate adaptation, obviously. If you think about some of the storms that are increasing, but also the rainfalls that now you can get, the volume of a month within an hour. And then cities need to adapt.
In New York, we definitely feel that.
After.
So to that point, though, I hear you, and politically as well, you get the CHIPS Act here, the Infrastructure Act, and the IRA, and there's so much money to be deployed so quickly. But I'm seeing a disconnect, particularly in industrials, about backlog and projects versus actually getting money, like people actually ponying up the cash. Are you guys noticing that right now too?
If we are honest, we need to admit, that all these stimulus packages in some respect have created some sort of a pause, because suddenly, people are saying, I could get a bunch of money. So then, I should wait to make my decisions. We've been some people hesitating between the stimulus in Europe versus the stimulus in the US. But what we can see is that traction is now coming. We already have a first project. For example, we work on the Nano Research Center in New York, Albany, which is funded by stimulus package money. And we still have other projects coming in. We also have the same thing in Europe with a very large semiconductor factory in Germany, 1 mile per 1 mile, so a very large thing. And definitely, there is the need for more of these elements, and then this is going to happen. But probably H2 will be showing us more of that.
So I would think for your business, those projects that you work on are just so multi-year projects. What kind of visibility do you have into your business going forward?
We have quite a long-term visibility. Our way of recording backlog, whatever, is very conservative, and then our backlog at any moment is not more than 10 months. But if we consider our entire pipeline, quite a number of our projects, like the Hudson Tunnel you are referring to, it's a several years project. So we have visibility in what's going to happen. We recently signed a strong project in Europe with Shell about gas extraction cleaning to get the remediation of the soil and convert that, potentially potentially either back into farmland, the one that's irradiated, or into different sort of air compression storage, for example, for energy. So this type of project give you a 10-year visibility. On some other different things, we have also large frameworks with some clients, that also want us to accompany on the long time, and very long-lasting relationship here in the U.S. with more than 70 years with some clients.
Yeah, and I know that, at least in my world, when I do energy transition stuff, a lot of businesses are just like, they're staying in the queue for stuff, even if they don't need it or they don't have the money right now, because it just takes so long to get on the line, which then benefits like companies like yours at the end of the day. I'm interested in terms of how you're managing costs. Like, where are you still seeing inflation? Where are you seeing deflation? And where do you feel like prices are sticky?
So I think we've been over the worst phase of inflation, obviously. But at the end of the day, when we talk about, such a large project like the Hudson Tunnel or other project we are in, the share of cost that we represent is super small. So I wouldn't be honest if I'm not admitting, that pushing inflation in our revenue has not been really a key question. That's been something, that the way we organize, the way we work, and what we deliver, for our clients has been something quite smooth, and the operating performance of the last few years have shown that.
So what type of specific consulting services do you provide? You focus, just trying to get a sense of what role you guys play in these different projects.
So ARCADUS would be able to intervene around any natural or built asset from the very beginning, conception, thinking and such, down to remediation and potentially dismantling. So that's where we operate, and in that space we will never take any construction risk. This is not where we operate, but we are really an advisor, a consultant that will be able to give environmental permitting, for example, or design, construction, architecture also. Things about the Fifth Avenue. We've been recently refurbishing the Tiffany store, but
that's you guys.
Yes.
Ah, okay. All right.
I hope you like
get a discount.
Yeah, right. So what is the hardest part of your business right now? Like, what keeps you up at night as CFO?
What keeps me up at night? My kids more than my job.
For sure. I totally get that.
Yeah, for sure.
I'm just curious as to what the hardest part of your job is.
This is a very fragmented portfolio. So, you need to have a view on everything, and you need to admit also that you can't have a view on everything at the same time. So it's the way you are organized, the way you make people, have the information that they need to make the relevant decision at any moment. And part of our new strategic cycle is really around that. There's more project outside that project that we can seize. So then what do we do internally to make sure that our sales force has the capability to make the right decision and not work on a first in, first out mode,
I see they have about 35,000 employees. Is it hard to attract and retain employees in your business?
There are some difficult elements, but obviously we've worked a lot on that. Maybe 1.5 years ago, we were above 14% attrition rate, which was quite high just after COVID.
Yep.
So we worked a lot into that, trying to understand what's happening. In terms of engagement score, now we closed the year of 52, which puts us in the highest quartile of our industry. And our attrition is down, just above 11%.
Are you back in Amsterdam? Are you back to office? Hybrid? What are you doing?
We are hybrid. We've reduced our office footprint by 35%,
Really?
over the last, yes.
So what is your policy? How does it work for you guys?
So
in Amsterdam, for example.
Well, I would not talk about the headquarters, because this is not where it is buoyant and where you have a life of the company. But in a normal office where we operate for project and for client, number one, you potentially have people with the client on mixed site working on the project.
Right.
From time to time, if we can do it, we love, having those teams in our offices, because that's, quite attractive and stimulate everyone. And we encourage them to come in the office 2 to 3 days a week, but we have, broken our capabilities in terms of open spaces and such to create more collaborative spaces where a team would gather and go into a specific meeting that they have prepared and where they want to collaborate on.
Okay.
All right, Virginie, thank you so much. Really appreciate your time. It was really wonderful to get that perspective. Virginie Duperat, she joins us, Arcadis, Chief Financial Officer. You jealous of the work?
Jealous.
Yeah, he is. He wants
jealous.
the remote radio working.
Exactly.
That's Paul's thing.
It works.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to sort of innovation, startups. How do you get it done? How do you start a business? What does it mean? How do you do it in the world of AI also? And there's a great person to talk to about this, Sunny Bonnell. She's co-founder and CEO of Motto, which is a global brand strategy and design firm focused on brand transformations for innovative tech companies. So let's get more on all of this and what it means and how hard it is to start a business. I certainly don't want to do that, by the way.
No.
Sunny joins us now. Sunny, first of all, what is Motto?
Well, we are a brand strategy and design agency, and we work on brand transformations for innovative tech companies, as you said there. We typically join forces with visionary leadership teams, executive teams at very pivotal inflection points in their business to help them sort of define what's new and what's next. And we really are known as this kind of big idea company. So we work with leadership teams to kind of find what is that big idea worth rallying around? How do we make it famous for them? How do we articulate it within the company and without the company in terms of external? And how do we get people really excited to champion and build that future with them? So that's kind of us working with all sorts of brands like Minnesota Vikings, Google, Hershey's, Virgin, and a lot of challenger startups as well.
So, Sunny, what's I guess some of the types of work you're doing now with clients, and maybe how has that changed over the years?
Well, I think a lot of teams in particular are, navigating a very tricky landscape. And so a lot of our work is really focused on leadership alignment. Many teams with the advance of AI, with the way the world is evolving and changing so quickly, they need to adapt and be very agile. And so what we're often doing is we're coming in and working with visionary leadership teams to sort of help them align around what is it that they're fighting for, what is it that they're fighting against, what future are they trying to move the organization towards, and how do we get everybody to adopt that and really buy into that future, and most importantly, really not just anticipate it, but really be proactive in trying to move their businesses to that future so they can remain relevant and achieve resonance in this wild landscape that we're all in.
Do you feel like companies, Paul and I were in Newark at NJIT earlier in the week, do you feel like companies and the C-suite really understand the role of AI in their business and like have the right vocabulary, have the right strategy, have the right outward facing stuff?
Yes and no. I think that leadership teams need to understand that AI is now part of the dominant conversation, and it is important to not only mobilize your team and understand the technology to become really fluent in the technology, but to adopt that technology company-wide. But I think it even goes higher up, right, with visionary leadership, which is what I really speak about and am an expert in, which is, how do visionary leaders help their teams not only see that future, but continue using these tools to sort of amplify it, to make efficiency greater, to just help them transform, to stay relevant and meet that new future.
Sunny, it used to be, back in the day, if you wanted to build a brand, you just bought a 30-second spot on, network television. Those days, I believe, are over. What are some of the successful ways or strategies that you've used with some of your clients?
Well, I think a lot of it is positioning, making sure that you have a very clear point of view. What do you stand for? What do you stand against? And more importantly, how do you get everybody both your audience and your internal team aligned to that? And then what is that sort of core story that you're trying to tell, and to remain that, to build that authenticity within the company? So you're trying to sort of have something to say, not just something to sell. And that's extraordinarily difficult when things are very competitive, when you have a lot of people in many businesses doing the same thing as you. What is going to define your competitive advantage? What is that cutting edge thing that you bring to the table? And how do you get people really excited about it? And how do you make it in a way that it's clear, it's compelling, it's articulate, and people want to be part of that dialogue? And so a lot of our work is really helping teams and organizations just define that. What is that big idea? What is that thing that you want people to rally around? And then how do we ultimately build that into the brand, into the mechanisms, into our ecosystem, into our language, into our brand's system, essentially, to get people really excited about that.
How did you get into this business, and how did you start your own company? What was that journey like?
Well, I was on track to be a veterinarian.
No kidding.
I was in college, and my partner and I dropped out of college in our early 20s to start Motto, and we had been moonlighting as designers on the side, and just kind of fell in love with it and started to be hired for it. And so that was 2005. This is 18 years later, and now we've worked with some of the biggest brands on earth. And it's a labor of love, because it's taught us how to evolve with times. I mean, when we started, it was yellow pages and digital ads, basically printed materials, whereas now everything's digital and everything's much, much more diverse. But back then, you had to really continue adapting every couple of years, and then also seeing organizations that you're working with also have to be agile and adapt. And your strategies and the way that you move teams forward is, some of it remains the same. Values and authenticity will always be at the heart, I think, of every organization. You have to know what you stand for and what you don't. And ultimately, again, what is your competitive difference? What is your point of view in everything? And so as brands become more demanding of, not only people demanding of, what do they feel about political issues? What do they feel about the issues of our time? You find organizations having to be and called upon to speak about these things, to really sort of plant their flags. And so that's why we call the company Motto, is because what is your flag? What flags are you planting, so that people can understand who you are as a rallying call for who you are?
We only have 20 seconds, but do you think if you had started this business today, you would have been able to do it? Has the environment just changed this much?
It has changed, but I think that would not have been. I think visionary leaders are driven by two things: innovation and progress. And I believe that if I had to start this business today, I would absolutely be able to. We would be able to do it, because I think that if you are a visionary leader, you're able to understand and follow, kind of move towards the trends and move your business towards that new future. So, absolutely.
All right, Sunny. I mean, really, starting my own business seems the hardest, scariest thing in the world. All right, Sunny Bonnell, co-founder and CEO at Motto. We super appreciate it. Kudos to you. That is quite a journey. Thank you for all of that.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube, and always on the Bloomberg Terminal.